Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Wednesday, May 5th, 2021, and I'm pre-recording this Trading Places Live for Thursday, May 6th. Futures currently are up a little bit after hours tonight. We do have the Dow Jones futures up about 57 points, S&P 7, NASDAQ 34. So NASDAQ still trying to make up some ground. It did so at the open on Wednesday, but then gave it back throughout the day. We'll talk about that in just a minute. But, it's been a pretty tough road here of late for the NASDAQ and many of the growth names. And we've seen it a lot even with strong earnings. Some of these companies coming out and posting great numbers and really not being rewarded for it. And I think you have to keep perspective in mind and just realize how much some of these stocks ran throughout the pandemic. And so I think a lot of what's going on is price is coming back as growth is moving up. And somewhere in the middle is where, I think we'll probably find a floor and we'll see these stocks turn back to the upside. But in the near term, definitely value is where the market is looking right now versus growth. And again, we're going to get into all of that in just a bit. Let's go through the agenda for today. I got some pretty good stuff, I think, today that we want to talk a little bit about. I'll get into the daily market recap and talk about what happened on Wednesday. Talking technically, I'm going to talk a little bit about that IWF versus IWD, give you a breakdown and explain some of the differences between these two ETFs and why I think it's important to continue to monitor this relationship, because I do think it gives you a really good indication, even if you're somebody that doesn't trade ETFs. If you're just a short-term trader, I think it's really important to understand where the market, what groups the market's favoring and what it's not favoring, so that you can plan your trades a little bit better. Then we're going to get into dividends. This is an area that I really don't cover very often, but we do have members at Earnings Beats that are interested in our income portfolio and some of the things that we do. But we don't really talk too much about dividend payers. So I want to show you a couple of interesting features at StockCharts and some of the things that you can do with these dividend stocks, these high dividend companies and companies that have paid dividends for many years. Then we're going to get into the earnings spotlight. Tons of earnings still coming out. Reactions to earnings are so much different than the actual earnings themselves. I mean, we get really strong numbers and still struggle sometimes with positive reactions. And we'll go over all of that and what we're seeing in after hours tonight on Wednesday. And then we're going to wrap up with the three you must see. These are three breakout stocks on the Dow. The Dow broke to a new all-time high today, and I think it's important to follow, what's going on in the Dow and the various components and what's leading that major index. So that's what's on tap for today. Let's move on over first before we get into all of that and take a look at earningsbeats.com, because if you are new to our community, we'd love to have you as part of our community by signing up for the Earnings Beats Digest newsletter. All it requires is a name and an email address. No credit card. It's free, completely 100% free, and you can unsubscribe at any time. But you will get 3 newsletters per week, Mondays, Wednesdays, and Fridays. Talk a lot about earnings, relative strength, and provide what I think are some pretty decent trading candidates from time to time. And so if nothing else, I think you could view it as very educational and maybe just give you a few tidbits maybe that you can pick up and utilize in your own trading. Moving on to the daily market recap for Wednesday, we saw the Dow Jones Industrial Average up 97 points. Moving to a new all-time high, closing at 34,230. S&P 500 up another 3 points, 4167. It's off of its earlier all-time highs that we saw at the end of April, but still hanging in above its 20-day moving average. There is a negative divergence, and there's also one on the Dow. So I wouldn't rule out some selling fairly soon, but we could still go back up and maybe set one more high on the S&P and maybe couple more days of solid action on the Dow before maybe that negative divergence kicks in. I think we've already seen the negative divergence kick in on the NASDAQ. We had the higher price, lower PPO, and we have now gone all the way down to test that 50-day moving average. So when the S&P gets weak, maybe we'll see a little bit of that money rotate back into the NASDAQ for a period of time. But, once we get to the middle part of May, historically, you got to lower the bar, what you're expecting. We've had a big run up in April and into the early part of May, which is typical. That's what we normally see historically. But then when you get in the second half of the quarter, we tend to see that reverse or maybe move higher, but just not at the same pace. So something to keep in mind as we move throughout May. Mid caps down 4, small caps down less than 1 point. So we did see that bifurcated action if we look across all of these 5 indices, with the Dow moving up, setting a new all-time high, the NASDAQ moving all the way back down to its 50-day moving average, and the others kind of in between. The small cap index also down close to its 50-day moving average. One thing I still think remains pretty strong is that accumulation distribution across the major indices. So I do think we go higher in time. It's just whether or not and to what extent we consolidate. Looking at the various sectors, energy and materials. I mean, this is where we've seen a lot of strength of late. Energy bouncing off, once we got out of that bullish wedge that I talked about maybe a week or so ago, energy's been very strong. It's held above that 20-day moving average, and now it's making a run to potentially test what could be a left side of a cup. Now it's starting to look a little bit like a cup off of an uptrend. So don't be shocked if maybe we struggle around 53 and a half, and then perhaps pull back to the 20-day. We'll see whether or not that materializes. The materials group, very, very strong, continuing to move higher, up another 1.27% on Wednesday. Financials, also a strong day, up about 0.8%, and breaking out to new highs. AD lines, very strong across these indices, across these sectors. Utilities and real estate, 2 defensive groups, were the 2 worst performers by far. Utilities down 1.7%, real estate down almost 1.5%. The utility group actually lost the support at the end of April and did fall back beneath its 20-day moving average. So maybe we're going to see a little bit more selling there. I would be looking for support below 64, maybe 63 and a half on utilities if it were to continue falling. Real estate, meanwhile, did close almost right on its 20-day moving average. Another weak day here, and I'd be careful. We could easily see a 50-day test. Utilities and real estate are areas that I don't really I think they go higher with the overall market. I just don't think they're going to be leaders. So I would tend to steer clear of most of my long positions, unless you're just a little fearful about the market. You want to, you're intentionally trying to take a little less risk. Then I think those 2 groups probably would be more appealing. All right, moving on to the 10-year Treasury yield. First, wanted to talk a little bit about tomorrow's economic reports. So by the time you're listening to this on Thursday morning, you'll probably have likely already seen initial jobless claims. But the expectation is for those to drop again. Last week, we had 553,000. This week, we're anticipating 533,000. Also, Q1 productivity coming out. Expectation there is for a big reversal from Q4. Q4, we had minus 4.2%. We're looking in Q1 to have positive plus 3.7% productivity number. So check that out. And looking at the 10-year Treasury yield, I thought what I would do on this chart going forward is not only show you the 10-year Treasury yield, but show you how that impacts areas like financials and industrials. So if you look at this chart, here's your 10-year Treasury yield. You can see that PPO of the 10-year Treasury yield is now flattened right on the 0 line. We saw this a little bit when we had this flat area back here in September. You can see we'd come back to the center line, and then we started this uptrend, and we've had that PPO above the center line ever since. I mean, it looked like maybe we moved just a little bit below mid-April, but essentially we're flat on the PPO. I think we're probably just going to consolidate here for a while, as I've been saying. I think 150 to the downside, 175 to the top side is what I'd look for. If we fall back below 150, I would just be careful with financials and industrials. That would be the key for me. I don't think that ends the bull market, but it might change the value versus growth picture. I think Treasury yields are going to have something to do with that. I don't think that's the only thing we want to be looking at, but if we see the 10-year Treasury yield break out again, whether I agree with it or not, probably we're going to see underperformance by many of the growth areas in the market, and value will probably continue to lead, at least in the near term. But you can see as we've been rising on the 10-year Treasury yield, look at the relative strength in financials going right along for the ride. Industrials, maybe not quite to the same extent, but you can see a similar type pattern here as well. And if you think about it, the 10-year Treasury yield, we're talking about bonds. Bonds are going to react negatively to a stronger economy. You're going to see them sell off, and therefore yields will rise. Well, when you get a stronger economy, what happens? You transport more goods. So that's why you're going to see industrials go up. Financials you're going to see go up because areas like banks and life insurance companies, as you get those yields moving up and the spreads widen, that's directly tied to their profitability. So that's why it's important to follow the 10-year Treasury yield, because it does give you some pretty good clues as to what you might be able to be looking for in terms of leadership in the market. All right, let's move on to talking technically. So today I wanted to go through and talk a little bit about the IWF and IWD. So IWF is the iShares Russell 1000 growth, and the IWD is the iShares Russell 1000 value. And I'll talk a little bit about each one of these in just a minute, but I wanted to show you on a chart the IWF IWD ratio. And you can see, over the past several years, growth has been outperforming. When we're in a secular bull market, which we're in right now, you can expect that our economy is going to strengthen. It's going to be strong throughout most of the period. And when the economy is strong, growth companies have the ability to grow their earnings at a much faster clip. And when their growth begins to accelerate, PE multiples expand, and growth stocks tend to do very well. And so if you look back over the last 4 or 5 years, you can see that that's been the case. And I could stretch this out. We could go back 10 years. And essentially, you're going to see growth for the most part ever since early 2013. And that actually, April of 2013 is when the S&P 500 broke out of the secular bear market that it was in. April 10th, 2013 is when the S&P cleared the 2007 and 2000 highs. So right here, and you might think that's coincidence. I don't think it's coincidence at all. That was a marker, if you will, a historical marker on that breakout back in April of 2013 that we were in it was a confirmed secular bull market. And at that point, you can see growth immediately took off to the upside. Now, this is where we got to keep things in perspective. I don't believe that the growth run is over long term, but we had such a huge run up that it's going to take a while, I think, now to kind of let things settle back into a more normal kind of feel. And I don't know if that means that we're going to come back and hit this trend line, which might take us down to, or actually, how do I get the QQQ back up? I don't want the QQQ. I mean, it's similar to the IWF, but IWF going back. Oh, I know. I had this in here when I went to the 5-year or to the 10-year. So let's go back to the 10-year again. So it's going to look very similar. There's 2013. Okay, so we had a final bottom in July. So the QQQ versus the spider is what I was looking at before. I apologize for that. But the IWF, IWD is very similar. It did bottom a little bit later, but since then is when we have seen this huge run up. But this same thing, same principle as what we were looking at with the QQQ and the spider, is we had this huge move up in terms of the relative ratio in the pandemic, during the pandemic. And a lot of it was because of the huge drop in interest rates. Also, many of these growth companies were able to deal much better with the pandemic. They were much more flexible. Their business models were more flexible. And so they didn't lose out on a lot of their business. Many of these value-oriented companies, have benefited from our economies reopening. When our economies were restricted in some fashions or shut down, their businesses were shut down in many instances. And so as we went through the pandemic, you can see this huge move up in growth versus value. And now we're seeing, since the November vaccine news, you can see that we've been pulling back. Money's been rotating. I don't think that this is necessarily a bad thing for growth. I think in the short term, obviously it's driving prices lower in those areas as we see money rotate. But I don't think the long term move up in growth stocks is over by any means. But in the near term, at least for now, we have to recognize that value is ruling the day and likely will continue to do so. I would be watching a few things. Number one, once we broke down on the IWF, IWD below 170, I thought that was a problem for the market and, well, for growth stocks, not for the market, but for growth. And we haven't been able to reclaim that 1.7 area. But I think likely what's going to happen is we're going to continue to see this rotation. I don't know if we go below 150. I think that's going to be a key area to watch. If we do go below 150, and 150 kind of coincides with this low right here. And also, if you draw a trend line coming up here, you're probably very close to that 150 level. Let me draw that trend line and see what we've got. Yeah, I mean, as we're coming down, you can see this goes up, and right now it's intersecting about 1.47 or so. But as time moves on, this keeps going up as this comes down. So I'm thinking that 150 level, 150, 155 is going to be key for the IWF, IWD. I don't think it has to stop there, but that's where I'd be looking for it to stop. So let's talk a little bit more about this IWF and IWD and what it is. So I'm going to take you over to Yahoo. This is the IWF, and you can click if you put IWF in the quotes area, and then bring this up and then click on this holdings right here. It'll give you some important information. So if you wanted to know, okay, what is the IWF? Well, it's an ETF, so it's a basket of stocks. And if you look, here are the top holdings in this basket. I think you'll probably recognize some of these names: Apple, Microsoft, Amazon, Facebook, Tesla, Google, Visa, NVIDIA, and MasterCard. So this group, these top holdings, represent 44% of the entire value of this ETF. So if these stocks right here don't do well, the IWF is not going to do well because 44% of the IWF is represented by these stocks. 20% is in Apple and Microsoft alone. So those two stocks are going to have a big impact and a big say as to how the IWF performs. The other thing I think is really important to understand is that the IWF is 38% invested in technology, 16% invested in consumer discretionary, and 12% invested in communication services. Those are the three very aggressive groups. If you add those percentages up, you come up with about 67%. Roughly 2/3 of the IWF is represented by the three very aggressive sectors. Now let's compare that to the IWD. So if we pull up the IWD holdings, let's go down first to see the holdings. You'll see, okay, Berkshire, JP Morgan, Johnson & Johnson, Walt Disney, Bank of America, Intel, Comcast, Verizon, ExxonMobil, and Cisco. Different vibe when you look at these companies. These are much more value oriented. They're not going to benefit as much by huge growth. Now, obviously, some of the banks, because they were horrible last year, they're going to show some real good growth numbers. But once you get past, this initial stage, this initial reopening phase, I think you're going to see that their earnings, companies like this, earnings are more easily predictable. They're more consistent. And so you don't see the volatility ordinarily in these types of companies. So the IWD, value oriented, you're going to see, companies that don't have the wild swings that many of the tech and some of the high octane discretionary stocks have. So that's one key difference. Another key difference here in the IWD is look at the percentage holdings. The top 10 holdings here only represent 16%. The top 2 holdings in the IWF were 20%, remember? Apple and Microsoft. This is a much more widely diversified ETF. So if you're looking at value and you're looking to own a lot of companies, that are more value oriented. The IWD is something that you absolutely could consider. As long as that IWD ratio that I pointed out right here, as long as this continues to go lower, I think your IWD is definitely the safer bet. And like I said, it's much more diversified. The other thing about the IWD is look at the sector weightings here. So in the sector weightings, you've got financial services 20%. Notice technologies under 10%. It was 38% in the IWF. Consumer discretionary, which I think was 16% in the IWF, is only 7% here. And communication services, which was 12% in the IWF, only 9% here. And you can see the weightings are much different. 1/3 of this ETF is financial services and industrials, two areas where the market's doing much better. So when I look at the IWF, IWD, it's for a number of different reasons. But the whole idea is to really get a feel for what the market is rewarding. Where is the market? What's Wall Street putting their money into? And that IWF, IWD ratio gives us a lot of information. All right, let's move on to dividends. So I don't talk a whole lot about dividends, but I'm going to go through and give you 12 very quick companies that pay strong dividends and have raised their dividends for at least the last 25 years, which takes us not through just this current secular bull market, but also through the last secular bear market, which I think is really important because these are dividends. I mean, you can never guarantee and absolutely count on every dividend being paid forever. But these are companies that have weathered storms and continued to raise their dividends. AT&T, 6.6% yield right now, according to Yahoo Finance. They've raised their dividend for 36 straight years. How about XOM? This is ExxonMobil. They've raised their dividend for 38 straight years. 38 straight years. And 5.88% is their current yield. Now, some of these stocks haven't, we just saw AT&T hasn't really done much. You can see ExxonMobil trading below where it was 7 years ago. So if you're getting into some of these big dividend payers, a lot of times it doesn't come with a lot of growth, and you need to be aware of that. But as you get older, you get closer to retirement, you're not worried as much about growth. You want to protect that income flow. These are some of the stocks that I would certainly consider. CVX, another one in the energy patch. This is Chevron. They have now paid their dividend for they've raised their dividend for 33 straight years. 5.08% is the current yield. Next up in the healthcare space, AbbVie, ABBV. They've raised their dividend 48 consecutive years. Current yield 4.57%. In the real estate area, Realty Income Corp, ticker symbol O, 4.08% dividend yield. 26 straight years they've raised their dividend. And outside of the big drop here with the pandemic, I mean, this has been gotten some pretty decent growth as well as solid dividends. AMCR, this is Amcor. Again, pretty steady grower in terms of share price. This is a company that's been, I don't know why the dividends here are showing this, but I think it was Newsweek that I got this information from as far as raising dividends for so many years in a row. But I think in that article I read, Amcor had raised dividends 37 consecutive years. ED, this is Consolidated Edison. 46 consecutive years raising dividends, and the yield 3.97%. PBCT, in the banking space, People's Bank, raised its dividend for the last 27 years, current yield 3.95%. Just got a nice breakout. Good to see that. Federal Realty just reported earnings, and the stock, again, not great long term in terms of growth, but 53 straight years it's raised its dividend and currently pays a yield 3.77%. Next up, Ben, which is Franklin Resources, has paid its dividend 39 consecutive years, raised its dividend 39 consecutive years with a yield of 3.50%. Walgreens Boots Alliance, WBA, has raised its dividend for 45 straight years, currently with a yield of 3.44%. and it's actually coming off a bottom, starting to trend higher. So maybe get some growth with that as well. And then the last one to round out the dozen, Cardinal Health. CAH has raised its dividend 33 straight years and current yield 3.13%. Also, it too looks to be trending higher and is broken above recent highs, moving to about a 3-year high now on Cardinal Health. So those are some of the dividend plays that you might be interested in. Let's move on to earnings. Earnings spotlight. We're going to start off with PayPal. I could spend a lot of time, but we don't have a lot of time. Let me just say this. PayPal beat top line, beat bottom line, guided higher. Stock is up about 4.7% in after hours. But after topping in February, I think we've got to just deal with consolidation here for a while. And among growth companies, if you can just simply consolidate, you're doing better than most because many of these companies are getting hit hard. Uber reported after the bell. They missed on their revenues. They did beat on the bottom line, although they posted a loss. Stock was down almost 5% after hours. So it's probably going to challenge this January low. Company that got hit pretty hard, RKT. This is Rocket Companies. Rocket beat top line, missed on their bottom line, though, 89 cents versus 91 cents expected. Stock's down 13% after hours. Let's find another one here. How about Etsy? Etsy easily beat revenues. Earnings came in at $1 versus 84 cents. Stock down 10% after hours. I think it was trading down to about 164 or so. So, these growth plays, even though the numbers are good, money's just rotating away from them. It's not that Etsy's not a great company. It's just in the wrong area right now, and the market is not really forgiving much. Let's see if I can find another one that reported that came in pretty strong here. QLYS, QLYS. So they beat revenues. Bottom line, 74 cents versus 69 cents. They guided higher, and the stock was up more than 13% after hours. Now here you can see this is a stock that had gone down quite a bit. So maybe it's getting just a little bit of a dead cat bounce with its earnings report, but they did guide higher. I would watch about 109. Break above 109, I think the stock could really move higher. I think in after hours it was up. It was under that, but it was up pretty nicely. All right, let's move on. Let's wrap things up with the 3 you must see. So I wanted to go through 3 of the Dow stocks today that broke out. First one, Caterpillar. You can see it breaking out there to new highs. AD line near a new high. Look at the relative strength. Everything going across here looks pretty solid. Caterpillar looks good. Goldman Sachs breaking out. AD line moving higher. Price moving higher. We closed at a new high. And when you look down here on the relative strength, you see everything trending up from left to right. Goldman Sachs looks really nice. And then the one that I thought looked the best today was actually Dow Holdings. DOW. This has been really strong volume here over the last couple of weeks as we bottomed near 60 and now ran up and took out that March high. I think Dow looks really good here. AD line breaking out. And also, again, looking across, I think relative strength is pretty good here. And of course, Dow is part of the materials area that has been so strong of late as well. All right, that is it for me today. Appreciate everybody tuning in. Your next earnings or your next Trading Places Live will be over at Earnings Beats on Monday morning at 9 a.m. Eastern. Hope to see you there. Everybody have a great day trading on Thursday. Enjoy the rest of your week. See you next week. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.